that, let's turn to our market master for the morning. Aditya Narain, the head of research, institutional equities at Edelweiss Securities, joins us now. Good morning, Aditya. Always a pleasure having you with us. Well, my first question really is to the overall universe of earnings. We just spoke to one of the task force gentlemen from Maharashtra, the Maharashtra task force. And they don't look very keen to open up everything even in June. Now, of course, a doctor will always talk very cautiously, and maybe the chief minister will be more pragmatic about the economic activity. But is Q1 really written off? Are we going to get even much in June? So, will you be seeing a lot of earnings cuts?
Okay, so I think interestingly, you've not really seen too many earnings cuts as far as the results season has been concerned. So I think from a market perspective, at least, people are not front loading some of the challenges that they're seeing at this point in time, right? That said, I think the bigger issue with earnings, if there will be any, will depend more actually in terms of how demand plays through rather than the constraints on supply. I think one shouldn't equate this first quarter with what happened in the previous year when everything was shut down. This time, quite honestly, there obviously are restrictions, but it's not exactly completely shut down. I think what you've really got to try and get a sense of is what is happening on the demand side. And as far as the mood is concerned, whether that is impacting stuff. So quite honestly, I wouldn't write off the first quarter, but clearly there is going to be a little bit of front end pain as far as the year is concerned because of, as I said, the shutdowns are a lesser challenge this time around rather than what it could do to demand.
Okay, got that. Aditya, hi, good morning. The biggest nifty loser this morning is Tata Motors, and the management has put out cautious commentary saying that these supply disruptions because of the restrictions are going to impact their earnings for sure. Does that set the tone for the entire sector? I mean, are you expecting the auto sector to face headwinds over the next 1 to 2 quarters, and would that make you cautious?
So, as I said earlier, I think the issue is, so we would be a little cautious on the auto sector in general, right? A lot of that actually resides in the view that discretionary demand, given what's happened, is going to be fundamentally weak for at least 6 months, right? And so to that extent, I think the auto sector falls flat in the face there, simply because that is a bit of higher end spend. This time, if you notice the lockdowns, there is a regulatory lockdown that's happened, but people themselves are not typically tending to venture out. So I think some of that will also reduce the kind of demand that you will see. So overall, yes, I think the auto space could see a certain amount of pressure as far as numbers are concerned. But once again, I would tend to believe the focus should be on the demand side rather than the restraints that are happening because of the supply side. I think the supply side will tend to, at the end of the day, in the context of the full year, be more a passing phenomenon. I think the demand issue could be a little bit more lasting. But specifically to your question on the auto space, we would generally tend to be a little cautious in that space. You could see some earnings cuts there, but it's more a question of what demand will pan out, what demand will be for a period of time, rather than necessarily what we are looking at immediately.
Well, Aditya, good morning, and that's precisely why I wanted to, question you on the first point itself. If demand is going to sort of wear off for a longer time, because people are cautious now, whether it's movie theaters or going out or even travel, general discretionary consumption, then is it fair to assume that this is just a max 1 quarter problem in terms of earnings? Whether it's coming to painting houses or any form of consumption for that matter. And therefore, is the market a little off the moorings at 15,000?
So I think I would say it's a 2-quarter phenomenon, right? And that is where I think we need a little bit more caution in terms of how the market is reacting, but not necessarily a whole lot more. Because as I said, we are still in May. The numbers are for the full year. It's not as if people have gone very aggressive for numbers this year. So I think a certain amount of caution, but not necessarily extrapolating to the full year, but I'd say a little bit more than the quarter at this point in time. You see, I think one of the interesting things that we've seen with the results season that has been playing out so far, and in terms of commentaries, as far as guidances are concerned, 6 months back, people were talking about growth numbers for FY22. Now what has happened is people are more confident about what will happen in 23 rather than in 22. So I'm not suggesting that it's been pushed out a full year, but I think there is a raised level of uncertainty that has come into the current year. And at this point in time, you're staring right into it because you've got some lockdowns and obviously you are near the peak in terms of the shutdowns.
Yeah, we hope so. We do hope so. We don't know about the third wave, and it doesn't look like we are going to be substantially vaccinated in 2021. And therefore, we do remain vulnerable. Anyway, that issue perhaps has to be decided by epidemiologists. Therefore, is it a safe bet to depend on externally dependent, externally focused stocks? Because the global economy is really going gangbusters.
I think that's fair. I think the certainty that you will see on the external side is going to be much greater than what you will see on the domestic side. The reality is the pickup on that side has already started happening, and they are less restrained by the supply issues simply because even from a manufacturing perspective, there are very little shutdowns there. And as far as the global side is concerned, it is very broad. Obviously you're seeing the US chug very aggressively. But you will see this extend a little bit to Europe also. And to that extent, there is, some of those recoveries, particularly the US, are already on a recovery path. They have already completely opened out. The supply side from India has been kind of fixed as far as that is concerned. And the numbers are beginning to come through on that side also. So in many senses, yes, I think the global side from a near term seems clearly much, much more comfortable. And we think it's actually reasonably sustainable also. So from a portfolio perspective, that's a space that we would look at. We've been looking at it for some length of time. I would also tend to believe that, apart from those economies opening up quicker, I think the policy approach has been stated upfront that we are going to go out, push money directly to consumers. Whereas as far as India is concerned, we've had one round of it. I think we need a second round to be debated. But that's just going to take a little bit more time. Whereas as far as the developed markets are concerned, the money is in the ground, the economy is showing momentum, and the economies are all beginning to open up much more aggressively.
Okay, so in that case, Aditya, will you prefer TAMO over Maruti Suzuki? Will you prefer Bajaj Auto over Hero Moto? Are you going to prefer, are my guesses right?
Absolutely. We've been making that call for the last couple of months. And if anything, given the second wave that you've seen at this point in time, it only kind of reinforces our view as far as these two shifts are tending to happen at this point in time.
Okay. What about some of these other consumption plays, the home improvement themes, the pipe manufacturers, the ceramic manufacturers? So for example, I know these are small spaces, but they've been doing really well. Astral Poly, for example, is the big mover today. It had some stellar numbers. We've had good, management commentary from some of the ceramic manufacturers. Anything that you like in this space?
So we generally like that space in its entirety. Without going into stocks, we like the space. How have they done in this last quarter? A little ahead of expectations. We were always expecting them to do well, but I think the momentum that you've seen has been very, very significant. I think what you also need to keep in mind is that these are a little balance between direct consumer purchases and stuff going into the industrial side. And I would suspect the industrial side is going to be more robust as far as this space is concerned. I think one other thing that's also happened in this last quarter is that there's been a certain amount of inventory revaluation. So that's pushed up the numbers a little beyond what is the underlying. But bottom line, I think that space looks like a comfortable space. I don't think you will continue to see earnings grow this way. I also think they are a little bit more hedged vis-a-vis other discretionary spends because there is a reasonably large industrial and investment component to it. So yes, we would stay positive in that space, but I think the numbers that you've seen in the last quarter, that's not something that is likely to reinforce itself sustainably.
Okay.
One minute, Surabhi. There are some flashes running from Aditya Thackeray, and I think he's spoken to the channel. Yash, our colleague, is reporting. The statements are exactly what you've seen on your screen. Too early to say anything on extension of restrictions in Maharashtra. Only factor to decide whether there would be any extension will be the number of cases. Aditya, are you worried that the governments are going to be more cautious this time in terms of opening up? And will that influence your stock selection?
See, I think in many senses, from a governmental perspective, there needs to be a prioritization, right? And particularly given what's happened. And to that extent, I think prioritizing lives over livelihoods at this point will remain an enduring theme. And I don't think the market should necessarily worry too much about it. So to some extent, I think it's going to be a slower unwind this time vis-a-vis what you saw the last time, simply because of the experience that we've all undergone over this period of time. To me, I think the bigger thing to look at is, have people got psyched out of buying? Has the risk perception within ourselves gone up? So we are not going to be spending money, or we are not going to be going out. I think that's going to be the bigger issue rather than the regulatory easing that you're tending to see, right? I mean, interestingly, of course, this time I think all governments have managed that lockdown much better than was the case last time. So a lot of basic activity has gone on. Supply chains have not really been impacted. I just tend to believe, rather than looking at what the government does with lockdowns easing, I think it's how people respond to this easing that I think will make more of a difference. So I think it's going to be gradual. I think the demand comeback is going to be gradual, unlike the last time. And I think that's where one needs to focus a little bit more on and try and make those calls. I think these are not discrete responses that you will either get from me or any other commentator, or in terms of the demand response that you see. I think it will be a little bit more wavy as you tend to see it play. But I would believe, I think the discretionary side, you just fundamentally need to be a little bit more cautious about than was the case last time. I think last time there was a pent-up demand argument also. I think given that the economy was open for 6 odd months, I don't think you will necessarily see that pent-up issue. And I think there's one other thing to look at, which is that costs have gone up, particularly on the commodity side, which could be a little bit of a challenge because a lot of products will need to be priced up if companies are to protect margins. And that again will work a little against demand, given that you're having to see price push-ups also. So bottom line, I would believe it's the call on the demand side that you need to make rather than focus too much on the supply side. And that's something you need to think through. And from our perspective, we generally be cautious on the consumer discretionary space, right? I think what you need to think about also is that the industrial side or the capex side or the investment side, I think that has got a clear tilt towards itself. I think that will tend to sustain. And if you do see the government coming out with something, I think a lot of it will tend to be towards spend, towards capex of some form, or just creating health infrastructure. And I would just tend to believe that from a portfolio perspective, it's the investment side that you need to look at more closely from an upside perspective than the consumption side.
Got that, Aditya. Thank you very much. It's a very broad theme you've given us to guess the stocks, not the consumption theme, but the investment theme is what Edelweiss is concentrating on. Have a safe week ahead, safe months ahead, Aditya.
Thank you, and stay safe, all of you too.
Okay, well, the markets in the meanwhile have moved into the green and the mid-caps firmly into the green. So we have, again, about 2.5 stocks in the green for one in the red. The Canada Bank stock immediately after numbers